When you're considering borrowing money, understanding the different types of loans is crucial. One common type is a secured loan, which requires you to provide collateral to secure the debt. This means that if you default on the loan, the lender can seize the collateral to recoup their losses. Common examples of secured loans include mortgages and car loans. By understanding the basics of secured loans, you can make informed decisions about your financial options. Key takeaways. A secured loan requires collateral to secure the debt. If you default, the lender can seize the collateral. Common examples include mortgages and car loans. Understanding secured loans helps you make informed financial decisions. Secured loans can provide a way to borrow money with potentially lower interest rates. What's a secured loan meaning? Understanding the concept of a secured loan is crucial for making informed financial decisions. A secured loan is backed by collateral, a valuable asset you own or plan to finance with the loan. Should you default, the lender can take possession of your collateral to recoup their losses. Basic definition and concept. A secured loan is defined by its reliance on collateral to secure the borrower's promise to repay. This type of loan reduces the lender's risk, as they can seize the collateral if the borrower defaults. The collateral can be a house, car, or other valuable assets. The concept is straightforward. The borrower provides collateral to guarantee the loan, and in return, the lender offers more favorable terms. Key components of secured loans. The key components of secured loans include the collateral, loan amount, interest rate, and repayment terms. The collateral is the most critical component, as it directly affects the loan's terms and the lender's willingness to lend. Here is a breakdown of these components in a comparative table. Component description: impact on loan collateral. Valuable asset used to secure the loan, reduces lender's risk, loan amount, the total amount borrowed, determines repayment amount, interest rate. The rate at which interest is charged affects total cost of loan, repayment terms. The schedule and method of repayment influences borrowers' financial planning. Understanding these components is essential for navigating the world of secured loans and making informed decisions about your financial options. How secured loans work. To comprehend the secured loan process, it's essential to grasp the role of collateral. When you apply for a secured loan, you offer an asset as collateral to secure the loan. This means that the lender has a legal claim to the asset until the loan is fully repaid. The collateral requirement. The collateral can be a valuable asset such as a house, car, or savings account. The lender assesses the value of the collateral to ensure it covers the loan amount. If you default on the loan, the lender can seize the collateral to recoup their losses. The collateral requirement is a critical component of the secured loan process, as it mitigates the lender's risk. Here are key aspects of the collateral requirement. The type of collateral accepted varies by lender and loan type. The value of the collateral is assessed to determine the loan amount. Failure to repay the loan can result in the loss of the collateral. Lender's rights and borrower's obligations. In a secured loan, the lender has the right to repossess the collateral if you fail to meet your repayment obligations. As a borrower, your primary obligation is to make timely payments according to the loan agreement. You also need to maintain the collateral in good condition and ensure it is adequately insured. Understanding the benefits of secured loans and the associated risks is crucial. While secured loans offer lower interest rates and higher borrowing limits, they also come with the risk of losing the collateral if you default. Common types of secured loans. Secured loans are not one size fits all. They come in several varieties to suit different financial situations. You can choose from a range of options, each designed to meet specific needs and offer unique benefits. Understanding these options is crucial to making an informed decision. Mortgage loans. Mortgage loans are a common type of secured loan used to purchase or refinance a home. The property itself serves as collateral, reducing the lender's risk. These loans often have favorable terms, such as lower interest rates, due to the secured nature. Auto loans. Auto loans are another prevalent form of secured loans where the vehicle acts as collateral. These loans are typically used to purchase a new or used car. The lender holds the title until the loan is fully repaid, and the loan terms are often influenced by the vehicle's value and the borrower's creditworthiness. Home equity loans and HELOCs. Home equity loans and home equity lines of credit, HELOCs, allow homeowners to tap into their home's equity. These loans use the home as collateral and can provide a lump sum or a revolving line of credit. They are often used for major expenses or debt consolidation. Secured personal loans. Secured personal loans are more flexible and can be used for various purposes, such as financing a large purchase or consolidating debt. These loans require collateral, which can be a savings account, investment, or other valuable assets. The terms and conditions vary based on the collateral's value and the lender's policies. Here's a comparison of the common types of secured loans. Loan type collateral, typical use, mortgage loans, real estate home purchase or refinance, auto loans, vehicle car, purchase home equity loans, HELOCs, home equity major expenses or debt consolidation, secured personal loans, various assets, large purchases, or debt consolidation. As illustrated in the table, each type of secured loan has its unique characteristics and uses. Choosing the right one depends on your financial goals and situation. Benefits of secured loans. One of the key advantages of secured loans is that they often come with more favorable terms compared to unsecured loans. This is because the lender's risk is reduced due to the collateral provided by the borrower. As a result, secured loans can offer several benefits that make them an attractive option for borrowers. Lower interest rates. Secured loans typically offer lower interest rates compared to unsecured loans. This is due to the reduced risk for lenders, as they can seize the collateral if the borrower defaults. For instance, mortgage loans and auto loans usually have lower interest rates because they are secured by the property or vehicle being purchased. Higher borrowing limits. Another benefit of secured loans is that they often come with higher borrowing limits. Since the loan is backed by collateral, lenders are more willing to lend larger amounts. This can be particularly beneficial for borrowers who need significant funding for major purchases or debt consolidation. Longer repayment terms. Secured loans can also offer longer repayment terms, making it easier for borrowers to manage their monthly payments. For example, a mortgage loan can have a repayment term of 15 to 30 years, allowing borrowers to spread out their payments over a longer period. As highlighted by financial experts, secured loans can be a valuable tool for borrowers who need access to significant funds and are willing to provide collateral to secure the loan. By understanding the benefits of secured loans, you can make an informed decision about whether this type of loan is right for you. Potential risks of secured loans. When considering a secured loan, it's crucial to understand the potential risks involved. While secured loans offer several benefits, such as lower interest rates and higher borrowing limits, they also come with significant risks that borrowers must be aware of. Risk of asset repossession. One of the primary risks of secured loans is the potential loss of the collateral if you default on the loan. For instance, if you've taken out a mortgage, your home could be repossessed by the lender if you're unable to make payments. Similarly, with an auto loan, your vehicle is at risk if you fail to meet your repayment obligations. To mitigate this risk, it's essential to carefully review your loan agreement and ensure you understand the terms and conditions. Long-term financial commitment. Secured loans often involve a long-term financial commitment, which can be challenging for some borrowers. For example, a 30-year mortgage or a 5-year auto loan requires a significant commitment to regular payments. To manage this risk, it's crucial to assess your financial situation carefully before taking out a secured loan. You should also consider creating a budget and a repayment plan to ensure you can meet your loan obligations. Risk description mitigation strategy. Asset repossession, loss of collateral due to default. Carefully review loan agreement, understand terms and conditions. Long-term financial commitment, extended repayment period. Assess financial situation. Create budget and repayment plan. Secured versus unsecured loans. Key differences. The primary difference between secured and unsecured loans lies in their structure and the risks associated with them. When you opt for a secured loan, you're required to provide collateral, which can be seized by the lender if you default on the loan. In contrast, unsecured loans don't require collateral, making them riskier for lenders. Collateral requirements. Secured loans necessitate collateral, which can be in the form of a valuable asset such as a house or a car. Unsecured loans, on the other hand, are approved based on your creditworthiness and don't require any collateral. This fundamental difference affects the lender's risk and, consequently, the loan's terms. Interest rate comparison. Generally, secured loans offer lower interest rates compared to unsecured loans. This is because the collateral provided for secured loans reduces the lender's risk, allowing them to offer more favorable terms. Unsecured loans, being riskier, often come with higher interest rates to compensate for the increased risk. Approval process differences. The approval process for secured loans is often more lenient compared to unsecured loans. Since secured loans are backed by collateral, lenders are more willing to approve applications even for those with less than perfect credit. Unsecured loans, however, place a greater emphasis on credit score and history. Default consequences. Defaulting on a secured loan can lead to the repossession of the collateral, which can have severe financial and credit score implications. Unsecured loans, while not risking a specific asset, can still lead to serious credit score damage and potential legal action by the lender. Understanding these key differences is crucial when deciding between a secured and an unsecured loan. Your choice should be based on your financial situation, the purpose of the loan, and your ability to repay it. Qualifying for a secured loan. Understanding the qualifications for a secured loan can streamline your application process. To qualify, you'll typically need to meet certain financial criteria set by the lender. Credit score requirements. Lenders often use your credit score to assess your creditworthiness. A higher credit score can improve your chances of approval and may qualify you for better interest rates. For secured loans, lenders may be more flexible with credit scores since the loan is backed by collateral. However, a good credit score is still beneficial. Income and debt-to-income ratio. Your income and debt-to-income ratio are crucial in determining your ability to repay the loan. Lenders want to ensure that you have a stable income and that your debt obligations are manageable. A lower debt-to-income ratio indicates a better ability to repay the loan, making you a more attractive candidate for a secured loan. Collateral valuation process. The collateral you offer must be valued and meet the lender's requirements. The valuation process typically involves an assessment of the collateral's worth to ensure it covers the loan amount in case of default. The type and value of the collateral can significantly impact your loan terms and approval chances. By understanding and meeting these requirements, you can enhance your eligibility for a secured loan and potentially secure more favorable terms. The secured loan application process. When you're considering a secured loan, it's crucial to grasp the application process to avoid potential pitfalls. The secured loan process involves several steps that require careful preparation and attention to detail. Required documentation. To apply for a secured loan, you'll need to provide specific documentation, including proof of income, identification, and details about the collateral you're offering. The lender will use this information to assess your creditworthiness and the value of the collateral. Typically, you'll need to provide pay stubs or tax returns as proof of income identification documents, such as a driver's license or passport, documents related to the collateral, such as property deeds or vehicle titles, timeline expectations. The time frame for processing a secured loan application can vary depending on the lender and the complexity of your application. Generally, you can expect the process to take anywhere from a few days to several weeks. It's essential to ask your lender about their specific timeline expectations to plan accordingly. Common approval challenges. Several factors can complicate the approval process for a secured loan. These include inadequate collateral, poor credit history, or insufficient income. To mitigate these risks, ensure that you provide comprehensive documentation and maintain a good credit score. By understanding the secured loan application process and preparing accordingly, you can improve your chances of approval and secure the funding you need. How to choose the right secured loan. Selecting the right secured loan requires careful consideration of your financial situation and goals. A secured loan can be a valuable financial tool, offering benefits such as lower interest rates and higher borrowing limits. However, it's crucial to approach the selection process with a clear understanding of your needs and the loan's requirements. Evaluating your financial needs. Before applying for a secured loan, it's essential to evaluate your financial needs. Consider what you need the loan for and how much you need to borrow. Assessing your financial goals will help you determine the type of secured loan that's most suitable for you. For instance, if you're looking to finance a major purchase, you may want to consider a loan with a longer repayment term. Comparing lender options. Comparing lender options is a critical step in choosing the right secured loan. Different lenders offer varying interest rates, repayment terms, and loan amounts. Shopping around can help you find the best deal that aligns with your financial situation. As the key to getting the best loan is to compare offers from multiple lenders. This can lead to significant savings over the life of the loan. Reading the fine print. Once you've narrowed down your lender options, it's vital to read the fine print. Understand the loan's terms and conditions, including any fees associated with the loan. Carefully reviewing the loan agreement will help you avoid any surprises down the line. Pay particular attention to the interest rate, repayment schedule, and any penalties for early repayment. Strategies for repaying your secured loan. To avoid potential pitfalls, it's crucial to develop a comprehensive plan for repaying your secured loan. This involves understanding your loan terms, creating a budget, and exploring options for early repayment. By managing your secured loan effectively, you can minimize financial stress and ensure that you're making progress towards becoming debt-free. Creating a repayment plan. Developing a repayment plan is the first step towards managing your secured loan. This plan should take into account your income, expenses, and other financial obligations. You can use a loan repayment calculator to determine the best strategy for your situation. Consider setting up automatic payments to ensure timely payments. Early repayment options. Paying off your secured loan early can save you money on interest and reduce your debt burden. Check your loan agreement to see if there are any prepayment penalties. If not, you can consider making extra payments or paying off the loan in full. Early repayment can also improve your credit score by demonstrating responsible financial behavior. Handling payment difficulties. If you're facing challenges in making your loan payments, it's essential to communicate with your lender. They may offer options such as loan modification, forbearance, or refinancing. You can also consider seeking advice from a financial advisor to explore alternative solutions. Being proactive can help you avoid default and potential repossession of your collateral. Repayment strategy, benefits considerations, standard repayment plan, predictable monthly payments, may not be flexible if financial situation changes. Early repayment saves on interest, reduces debt faster, check for prepayment penalties. Loan modification can reduce monthly payments or interest rate. Requires lender approval, may impact credit score. When a secured loan makes sense. In certain financial scenarios, a secured loan can provide the necessary funding and flexibility. You can benefit from lower interest rates and higher borrowing limits, making it an attractive option for various financial needs. Major purchases. One of the primary uses of a secured loan is for making major purchases, such as buying a home or a car. The loan is secured by the asset itself, reducing the lender's risk and often resulting in more favorable terms for you. Debt consolidation. Secured loans can also be used for debt consolidation, allowing you to combine multiple debts into a single loan with a lower interest rate. This can simplify your financial obligations and potentially save you money on interest. Building or rebuilding credit. Additionally, a secured loan can be a tool for building or rebuilding your credit. By making timely payments on the loan, you can demonstrate your creditworthiness and improve your credit score over time. Conclusion. As you've explored the concept of secured loans, it's clear that understanding their meaning and implications is crucial for making informed financial decisions. A secured loan, by definition, requires collateral to secure the debt, providing lenders with a level of security in case of default. The definition of a secured loan encompasses various types, including mortgage loans, auto loans, and home equity loans, each with its unique characteristics and benefits. By grasping the secured loan meaning, you can better navigate the lending landscape and choose the most suitable option for your financial needs. Secured loans offer several advantages, such as lower interest rates and higher borrowing limits, making them an attractive choice for major purchases or debt consolidation. However, they also come with potential risks, including the possibility of asset repossession. By weighing these factors and understanding the terms and conditions, you can harness the benefits of secured loans while minimizing their risks. Ultimately, a thorough understanding of secured loans empowers you to make smart financial decisions, leveraging these loans to achieve your goals while maintaining a stable financial foundation.